Fred, Chad, Phil, Bernard, William. How are you guys? Discord users, good morning. Start Discord. Okay. Right, then let's start. Oh, welcome on the YouTube channel. Welcome to Tradespoon and Yellow Tunnel. My name is Vlad Karpel. I'm CEO and founder of Tradespoon and Yellow Tunnel. Today we're going to have a live trading room open to trade stock and options. For those of you who are new, welcome. If this is your first live event, do me a favor, type in first. Always want to welcome new subscribers. This is my brief bio as Executive Vice President, Head of Technology at Options Express. From 1999 to 2007, Options Express was an online broker-dealer acquired by Charles Schwab. At some point, the company was worth over $2 billion. I want to take this opportunity to say thank you to all subscribers. Because of you, I'm able to do what I enjoy professionally, managing and trading money. Excuse me. I've been doing that for over 15 years. Managing and trading. Mentoring subscribers how to trade stock and options. And finally, I have master's degree in computer science, specializing in statistics and artificial intelligence. Disclosures are very important. Trading stock and options involve risk and not suitable for everyone. If you're new to trading stock and options, I encourage you to visit optionscreening.com to understand the risk associated with trading stock and options. I'm not a financial advisor. I'm not registered with FINRA nor SEC. I'm showing you what I do in my own account based on my own risk tolerance level for general education information purposes only. Please consult your financial advisor prior to making any trading decisions. Also, should not be assumed that the future trade picks will be profitable with equal past performance. All right, it's Wednesday, so let's do a deep dive into trading psychology. Not a deep dive, but at least high-level overview. From my perspective, these are the five, pillars of trading, right? And everything kind of follows based on this foundation. The first pillar is dichotomy of control. Welcome. Let me share my screen. We have some people on. Just type in any questions in case you have them. All right, so one is the economy of control. The idea of the economy of control is process versus outcome, right? Usually when we start trading, we only care about outcome in any shape or form. As long as we achieve the desired outcome, this is number one priority, right? As you learn and as you trade and as you continue on your journey, you realize that if you only concentrate on control, on the outcome, then trading can be very, what's the right word, stressful or sometimes disappointing, because trade doesn't go in your direction, and what you think is going to happen doesn't happen, right? Because it is outside of our control. So at some point you realize the only thing you can control are your thoughts and your actions, right? You cannot control the outcome of the Fed decision today, right? Fed could be hawkish, Fed could be dovish. Market can react positively to the hawkish statement, or they can react negatively to the hawkish statement. So you cannot control the outcome of that event. The only thing that you can control is what do you do to in your portfolio to prepare for this event, right? What is your beta of your portfolio looks like? What is the delta of your portfolio look like? How many long positions do you have? What is the maximum size of each position? So what's the maximum of portfolio drawdown? How much cash do you have on account? right? Those things you can control, right? And you can control your thoughts. How do you try to interpret, the Fed statement? But anything else, you don't have a control. So to me, this is number one foundation of the becoming a disciplined, successful, confident trader. As long as you concentrate in just an outcome and you're willing to sacrifice the process or deviate from the process, it will be very hard to consistently making money. Yes, you can be successful for a couple of days, maybe a couple of weeks, couple of months, couple of years, but at some point you will realize that the process is more important than the outcome. Second one is negative visualization, right? Innately, the way our brain works, we're protecting us from any negative experiences or thoughts, right? But in trading, you have to go through these visualization routines, right? Positive and negative. And negative visualization, reviewing stop loss orders, preparing for if the trade goes against you, and be ready for both if the trade goes successful or unsuccessful, right? So right now we are approaching Fed decision, right? Probably one of the most important events this week, along with unemployment numbers on Friday. And the next we have CPI data and the midterm election. So one can expect more volatility in the market. We are trading a clearly defined range. Let's see. So according to Stock Forecast Toolbox, our main model that learns and trains on the data makes forward-looking prediction based on the neural network engine. Predicts support at 384, overhead resistance at 392. That the market will trade between 380 and 390, and right now the bullish trend, the bias is bullish going into the Fed decision and unemployment number for 10-day forecast. Now, if you zoom out, the previous screen was, each data point is 1 day. This is where each data point is 1 month. So long-term predictions for spiders, still negative trend, basically saying that we have reached the top and there is really not much room going higher. Does it mean that 386 is the top and it's not going to go higher? No, it can overshoot by, as much as 5% we've seen in the past, right? So maybe 400, maybe 410, but the room is getting thin on the top, the air is getting thin to the upside, right? So it doesn't make sense to chase the market, potentially wait for the pullback because, the rally might continue beyond midterm elections, right? And that's what usually happens, but not a lot of momentum to the upside. So let's say you think that going into the Fed decision, market will, right? There's only two things that are going to happen after the Fed decision, right? We're either going to overshoot to the top, 400, or we at least retest to the bottom, and I would say it's 367, right? That's the next support. So market can jump, call it 15 points to the upside, and 367, maybe 25 points to the downside. 367, no, 15, 367, 15 points to the downside. 367 will be 15 points, right? 367 plus 15. Yeah, it's too early in the morning. I didn't have enough coffee. My brain doesn't work very fast. Okay, so 15 points to the upside, 15 points to the downside. If you're, let's say, going bullish, right? I'm bullish. I think this is, 380, 370, good time to buy. Where's my stop loss? Right, my stop loss is right around this 367 level, because I know that if this level doesn't hold, right, which is June lows, right, if the June lows will not hold again, we will probably reach quickly to 350 or lower. So I propose that your stop loss is 15 points. if you're bullish and you're looking into midterm elections and end of the year. So how do you determine the size? On the $10,000 portfolio, right? On the $10,000 portfolio, I propose not to risk more than 2.5%. That would be $250. $250, 15 shares. So okay, then if my stop loss is 15 points, then 15 times 15 is roughly $250. Right, so I can buy 15 shares, right? 15 shares with 15 points stop loss. Right? And if you trade in any other asset classes, they are very highly correlated, right? Technology stocks, consumer discretionary, staples, doesn't matter what it is. I would use that stop levels to get out of your long positions. So you have, so that is the calculation, and I would encourage you to journal, right? To journal, we showed an example of journal. So if you go to Elite Circle, you go to a trader log. I do it on PP, no AMD. Let's go to AMD. Okay, so in AMD trade, right? I sell out of the money call spread and put spread, right? Taking advantage of the elevated volatility from AMD. AMD is up 3% after the earnings. It's trading at $61. I'm sold 69 call and I sold 51 put. Right, so 34 cents plus 26 cents is 60 cents, right? About 1%, and now I need to close the trade, right? So that's, again, you would want to write down in your journal exactly what you're doing. You know, iron condor, SMH stocks with an estimated reaction move, selling iron condor. If AMD trades within 1% of the short strike, consider selling short or, you know, hedging your position, right? And, you know, I would also document, you know, Fed decision creates uncertainty and the risk that if the, you know, if there is a bullish reaction, right, that AMD potentially can reach 69 level, right? I mean, so far it's pretty far away. It has to move significantly, but that's the risk, right? And you write this down and you determine what your stop losses is, right? You write it down. You know, if the trade is against me more than $250, I'm out of the trade, right? I don't want, you know, that is my risk tolerance level on a $10,000 account. So journaling is extremely important. Writing it down and following your plan is extremely important. You know, our goal is to avoid fight or flight response. How do you avoid fight or flight response? You know, if the market sells off 5%, my goal is to be down less than 10%, right? Let's say I'm bullish. I am bullish, not let's say, I am bullish right now in the market. I think it will continue going higher. Maybe not a lot, but still higher. My goal is, I realize that Fed could be hawkish, especially with the, you know, JOLTS number yesterday. Opening jobs continue to be high. Unemployment is probably going to be continue to be low. You know, PMI is still decent, still. So they're bullish case, right? Earnings are better than expected outside of technology, right? If you don't consider mega cap technology, earnings are better than expected, right? Employment is healthy, economy is healthy. You know, Fed can come out and just say, listen, you know, we're just going to keep raising 75 basis points at a time, and we don't really have timeline when we're going to lower the 50 to 75 basis points. If they say something like this, we're at 350, right? We're quickly at 350. My goal is to be down less than 10%. Then I know I can, you know, you know, weekend comes along, and, you know, am I happy that, you know, I'm down, you know, 5-7%? Probably not. But, you know, life moves on, and I'll have to readjust my positions and move on. If I'm down 20%, if I'm down, 20% or 30%, this is where I'm probably going to spend a lot of time thinking about what I did wrong, and how could I have not predicted what Powell is going to say, and why didn't I look at CPI data? Why didn't I look at PCE data? Maybe that's more important. You start doubting yourself and all that other stuff. But in reality, the only problem is that my position size, the number of positions, was just too high, right? So this is number one, not number one, but fight or flight response, right? You want to avoid fight or flight response. You want to understand who you're trading against, right? Game theory, who's watching the Fed decision, how will it affect treasury markets, how will it affect, currency markets, how will it affect gold, silver, utilities. So you have to understand who's listening, who is trading, and who you're trading against. And then, right, because there's, law of, thermodynamics, right, third law, that energy is constant, right? Some people make money, some people lose money, but the number of dollars, they expand, but but obviously, for every dollar somebody loses in stock markets, somebody gains. So compounding investment, right? The idea of compounding investment is, we go over this concept quite a lot, right, you look at this trade, right? I'm in AMD trade. I was able to collect 34.60 cents, 1%, right? 1%, I'm managing $6,000. One might say, well, 1%, $60, it doesn't make a difference in my life, right? I'm not going to, retire on $60, nor, a cup of coffee costs almost $10, right? But the idea of compounding investment, that even if you can make 0.5% or 1%, in short period of time, 1 or 2 days, then you can make 1% a week, you can make 4% a month, you can make 48% a year. This is how you think, right? And we're all different, right? I understand that maybe if you're managing $100,000, $60 is not a big deal. It's not a big deal. If you're managing $500, maybe $60 is a big deal. So we all have a different journey. We all have a different risk tolerance level. We all have different goals. But the point is to be consistent. To be consistent. So I propose to be consistent. You have to follow these rules, right? One is number of positions. Keep them on, 4 on average, right? I understand that some of you have 8 and some of you have 2, but on average 4 positions. As long as you're consistent, right? As long as you always have 2 or you always have 8, and you're comfortable with this, you understand what you're doing, no problem. And then you have the size, right? In terms of not losing more than $250. No matter what you do, you can trade Bitcoin, you can trade futures on options, on double options, as long as you're not risking $250, right? And the third one is controlling the size. For options trading, if I would propose that if you're managing $10,000 account, you only trade stocks that are less than $100 strike, right? And you only do one contract. Well, $100, right? You always do, let's say, $10,000 worth of equity, right? If you're doing short-term trading, right? So if it's a $60 stock, you do one contract, but if it's $50 stock, you do 2 contracts. And if it's $25 contract, you do 4 contracts. But you always managing $10,000 worth of equity. You might be more conservative. You say, no, Vlad, that's too much, only 5,000. But you always, if you multiply the strike price by the contract size and number of contracts, you always managing the same amount, right? So always the same, converted into equity, right? Understand how much equity you're managing, right? Underlying assets. Same thing if you're trading futures, right? If you're trading futures or you're trading Forex, you might be risking $5 or $50 on Forex, but you're managing $100,000 worth of euros, right? So the size should be always the same. Any questions? All right. Meanwhile, let's okay. So AMD, we gotta manage AMD. Meanwhile, spiders are down slightly, going to the Fed decision. Some of the earnings play, AMD is up 5%, DVN is up 6%, Airbnb is down 5%. I know some of us have doing these earnings play. In the earnings power trader in the lead circle, right? I've done, we've done AMD. So let's manage AMD first. I'm going to put an order to try to close. Ideally, want to close it before, Fed decision if it gets close to the strike price. So let me see what it's trading at right now. Any questions, please enter them. Discord, YouTube, guys, let's see. We're live. For watching, perfect. All right, so on YouTube, if you're live, we do have 4 people watching. Please type in any questions you might have. Welcome. All right. All right, so elite circle, let's look at. So managing 2 iron counters right now that deal with earnings. One is the British Petroleum and one is AMD. All right, so the short put, 51 put, we can try to close it for 3 cents. And then short call also for 3 cents. Right now, there's still volatility. So the premium in short call is still there, right? Because the expectation that AMD can continue going higher, especially after the Fed. If it's dovish, it can continue going higher. So I'm putting order to close both short and short call. First of all, it's very capital intensive strategy, right? I sold 69 call, bought 80 call. That means the requirement is $1,000, right? So broker deal will require $1,000 to be in your account to look for this, 634 plus for the 60 cents, spread gain. So that's AMD trade. Let me know if you guys have any questions. Other than that, let's look. DVN is down 5%. Let me look at DVN. PSX is down. ExxonMobil, so looks like energy is down. Give me 1 second. All right. All right, let's review the other positions. Let me know if you guys have any questions. Let's see. William, good morning. Fred, loud and clear. Charles, Fred, great day in New York. Cautious. Thank you. Phil. Lalit, Marvin, good morning. Biden plans to run for re-election. Thank you for that news. Bob, present. Desi, welcome. For rate hikes in the future. So Von Sidar had a question about the hikes. Let's see. So again, it's more of a trading psychology, right? So everybody already expects the Fed to raise by 75 basis points and potentially by 50 or 75 basis points in December, right? The question is, what is the tone or what is the language will be about the future, right? Because the Fed has, $8 trillion or $7 trillion worth of debt, right? Historically high debt that they have to refinance every year. So when the interest rates are above 4%, 4, 5, or maybe even higher than 5%, if they're going to keep raising at 75 basis points, at what point will the system breaks, right? So that's what everybody is thinking about. So at some point, Fed have to they don't have to pivot, right? They're probably not going to pivot. Was the CPI data we had, and was the job openings. Fed is not going to pivot, but they might say something along that by March they will at least slow down the rate of hikes, right? Instead of 75 basis points, they might raise 50 in December, maybe 50 in January and 25 in February, right? Some language that indicates that the speed and the magnitude of the rate hikes will slow down, right? So that will be interpreted as a positive by the stock market. But if they basically do not give any language and basically say we're going to be data dependent, right? The inflation is persistently high, we're going to raise 75 basis points this year, and there is still possibility of raising 75 basis points into the next year, depending on the data. If that's going to be the language, market is going to probably not like that statement and sell off, right? Exactly what the expectations, because you see a big drop in 10-year yield, right? We went from 4.5 to 4 or 4.4, 4.34 to 3.91, right? Pretty big drop in interest rate. The expectations is that the language will indicate that the rate hikes, the magnitude of the rate hikes will slow down, right? Or pause at some point, in Q1 of next year. So there's two reactions, either like this, if they're hawkish, right? We can continue going higher and then the market will sell off, right? Just like it did in October. Or it could be like we had in June and July, right? We pull back, right? And then we continue to drop, right? So this is scenario one. This is scenario two, what will happen to the rate hikes. We know what happened to the equity market in July, August, right? Spiders went up, right? S&P rallied 20%, not 20, 15%. And here, S&P dropped. So market predicts basically this scenario, that they're going to be dovish, right? And the market will continue its rally, right? That's what already factored in. That's why, value stocks are already up as much as they were in June and July. So if that expectation changes, so will the market. Let me know if you have any questions on Discord, on the YouTube. All right. Okay. Any questions? Carmen, good morning. Carmen, Dr. Maneker, yes. So Dr. Maneker, well, I don't have his web, but the website, Maneker web. Dr. Maneker, Andrew Maneker. So again, on Yellow Tunnel, a lot of content and webinars that you can find on the trading discipline with Dr. Maneker. He's a professional trader and clinical psychologist. He's, probably helped me tremendously. I encourage you to consider joining his program. Please tell him that you from Vlad, so he knows. But Andrew Maneker, so you can contact him here. But you can contact him here. All right. Right. That's my opinion hasn't changed about long term. So for the next 6 months, I think this is a short-term rally. I still think that the best part of the rally is probably behind us. I do understand that, from, seasonality point of view, market can continue incrementally, can continue going higher in November and maybe even December. But, as we approach in the next earnings season in January, companies like Amazon and Microsoft, Apple, they'll probably have worse earnings than they had in Q3, right? Q4 is probably going to be worse than Q3. And that means that the market, according to the model, in the next 6 months, we are approaching 300 level. And that is my core scenario. I agree with the model. The top 386 might not be the case, right? That might not be the case, but by June, I think we will get to the 300 level. And that's my core scenario, and that's how I will trade for the next 6 months. Unless I see data otherwise, right? If Fed will pause and inflation CPI data drops, then we have to adjust, right? Model doesn't know. When model makes this prediction, it's not being trained on CPI data, predicting CPI data or predicting what the Fed will say, right? That's impossible. It basically looks at the current trends, current volume, current price action. And if that price action continues, we can reach 300 level. We don't have to reach 300 level, but we might reach 300 level in the next 6 months. So assuming that this inflation data will be similar to what it was, right, and assuming Fed posture will not significantly change in the next 3 to 4 months, then market will potentially can drop to 300. If the Fed will pivot, right, the Fed will pivot and CPI and inflation data will drop significantly, we have to get back to the whiteboard. But until then, that is what the model predicts. Carmen, thank you. Lamsidar, let me know if this makes sense. All right, any questions so far? Let's review the positions. Let's look at the earnings. So yield kind of flat, TLT flat, dollar, everybody's waiting, right? We're kind of waiting. Weeks is complacent, 26, relatively. Everybody's waiting. Everybody's waiting for Fed, okay. So do expect more volatility in the market, right? Next 2 weeks, market is going to be extremely volatile, either to the upside or to the downside. So the most important is to concentrate on things that you can control. Cash, 50%, not 4 positions. And if you have all bullish positions, I propose to have market neutral portfolio out of these 4 positions. Have 2 bullish and 2 bearish. You can express slightly bullish or, maybe more bullish position, maybe a little bit more bearish position, but be market neutral. This way, that maximum you're going to be down. If you follow the 2.5%, you could be down maybe 2%, maybe 4% if the market drops 10%, right? Because your bullish position will lose money, but your bearish position will gain money, gain. And you know that this up and down action is going to continue, right? It's not like anything's going to be different in the next 6 months. Most likely, we are going to trade in this, pretty well-defined pattern, right? Of lower highs and lower lows, right? So this pattern is going to continue. Right, on and on and on, I don't know, every 2 months, every month and a half, every 4 weeks, however, going back to physics, when you look at sine cosine, right, we can go back to sine cosine, you can determine the amplitude of the move, the time series of the moves, right? This is not a periodic movement, right, but close to periodic movement, All right, let's review positions. All right, so AMD, the put got filled. The call is still. All right, so puts I'm out because AMD is up, but 69 call is still trading at 13 cents. So I'm going to wait, right? I mean, it's still pretty far away. If it was closed, I would probably close it, not take the risk. But right now, AMD is still, let's look at AMD. AMD is $62.57, so still further out. And then DVN, let's look at DVN. Continues to drop. CVS. So far, only DVN is trading outside of the range. So potentially selling short the stock is one of the way to hedge. All right. Let's see what else is cooking. All right, so we talked about AMD. BP getting close, right? BP is down 60 basis points. I still have the short put, right? Same thing, Iron Condor. Sold 14 cents, 13 cents, 25 cents on a $30 stock. So again, looking for 0.5% to 1% gain. The short call got filled, and I still have short put, the 31 put. It's getting close to being executed. IWM. One of the theories is that with a strong dollar, that the small cap national companies are less impacted by the strong US dollar. So I'm still bullish on IWM. Have an order to close at $1.70 to $2.80 credit put spread. NOC, still trading around NOC position. It's down today. So for now, continue to hold the position. Let's look at NFC. Pretty clear breakout. If it pulls back to 500, I would add to a position. Right? I mean, it can move 10%, right? So I would, again, position size is extremely important, right? If, let's say, NOC drops to 500 or 480, if you're down more than $250, I would exit out the position. If you're down $100, then consider adding to a position, right? So size is extremely important. And we know that NOC can move, here from top to bottom, it moved 15%. Here it moved, 10%. So you have to realize that if the stock can move 10 to 15%, then if it does move 10 to 15%, and it does it on a regular basis, you have to size it accordingly to make sure that if it's down 15%, you're not down more than $250. Because if you are, then you have to exit the position. You have to follow the rule. But if you're not, okay, then you can add the position. Vamsidar, how do the banks like Wells Fargo and Bank of America benefit from rate hikes? So usually you need steep yield curve, right? So the yield curve, right? If you plot the yield curve, and this is maturity, sorry, this is yield. This is yield, and this is time, right? For your yield, the 2-year yield should be less than 5-year yield. Should be less than 30-year yield. 10-year yield, right? And if the curve shifts higher, right, this is when the banks make a lot of money, right? This is good for banks, right? And this is a normal bull market, right? If you look at the yield curve right now, it's the opposite, right? The 2-year yield yields more than 10-year yield, right? So by nature, you would say, that doesn't make any sense. Why would, if I hold the bond longer, I would get less, money? And the reason for that is that the expectation that the interest rates will start going down, right, in the future. But short term, they're going to go higher. And that's why you have this now 50 points differential, right? So when the yield curve looks different, like this, right? Or if it gets steeper, this is bad for banks, right? This is bad. Right? If the 10-year yield drops more than 2-year yield, right, or the differential the inversion either stays the same or higher, then the banks are affected negatively. Let me know if that makes sense. Does the 2-year bond used to pay 2.6, pay 4%? What does it mean? It means that, if you have cash, if you just want to make 4.5%, then you invest in 2-year bonds, right? 2-year treasury notes, which a lot of companies do right now. I mean, I have friends that, have large cash position in their corporate accounts. They're just putting it in the treasury, right? Because, why take a risk where, as long as the US government is solvent, you get paid 4.5%. So that's what it means. But for the perspective of the US government, the problem is, how do you refinance, $8 trillion worth of debt at 4.5%, right? That's going to eat up a lot of your revenue from IRS, right? So that's a problem. Carmen, what do I do for hedge? So there's a couple of hedge positions I have. One is the QQQ, right? I do have 270, 250 put spread, expires in March. Still holding that position. I still have SH. If you're not comfortable trading options, I encourage you to consider SH as one of the hedges for the pullback. Right? You just need to size it correctly, right? If you have if you have $10,000 in spiders, puts, calls or stock, right? If you the way my brain works is that, okay, let's say I have $10,000 portfolio, right? Let's say I have $5,000 worth of this portfolio. Well, you shouldn't have 5,000, but you should have, let's say, at least 50% in cash. So I would say 5,000 should be in cash, right? Now let's say you have 2,500, right? You have 2,500, either calls or stock, right? But you translate calls into the equity, right? So how do you hedge this $2,500? I mean, you can buy $2,500 worth of SH. Then you're one-to-one. If you're bullish, maybe you buy less SH. Maybe you only buy $1,000 of SH. But that's how I would think about your portfolio composition, right? Either buy $2,500 of SH or $2,500 worth of, of hedge, QQQ hedge. On banks, still have XLF put spread, 30 put spread. I close my call spread. So I have, for every long position, I have short position. For every long position, now I have a short position. XLF and then XOP. Right? XLF and XOP. How's XOP doing today? Yeah, so XOP looks like it's losing momentum. It's down. Let's see, watching. DVN continues to trade lower. Okay, let me see. I have to prepare my DVN position. Give me 1 second. So this is a perfect example. I sold 72 strike, right? Sold 72 strike. You don't have it in earnings power trader or elite, but in my personal, I sold 72 put. Now it continues to drop. So I took a pause when it was at 70, it rebounded back, right? If you look at the 15-minute interval, right, it rebounded back to 72.50. I sold short the stock. Now it's at 71. So now I can, close basically the entire position and, basically break even. And I'm going to do that right now. Let's see. Give me 1 second. So I can close the 72 put. And then I can close the short stock. So this is an example where it's important to kind of go through this negative visualization exercises and be prepared that if the stock goes against you, know exactly what your plan is, right? Right. So if you sold 72 put, market opens, right? We go quickly from 75.50, lower, 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 lower. We're approaching your strike price. You got to do something, right? You can't just watch. You either close for a loss or you sell short the stock, right? Short stock doesn't move at the same rate as the short put, right? So at this point, you either made money or broke even, right? But if I was just sitting and waiting, I would be down, $1 right now. So this is a good example of the hedge. See, CVS, I have more room. So CVS is trading at 98. I have one-on-one call, right? So for now, I mean, if it breaks through this level, then maybe buy stock, right, to get into a cover call. But for now, I wait. It's 9:12. I have time. All right. Any questions so far? Poll, Kevin, do a poll. Which way market breaks? All right, let's do a poll. Let's do a poll. And I'm going to try to predict what everybody's going to say. All right. So the poll is, well, two things, right? There's two scenarios, right? We're 382. All right. Probably by, it's either going to be 400, right, by Friday. Let's call it this Friday. By Friday, will we be at 400 or will we be at 367? Right, scenario 1 and scenario 2. How many of you say 1? How many of you say 2 by this Friday? That's the poll. 1, we're going higher. 2, we're going lower. Double calendar spread, less risk, higher profit than iron condor. Double calendar spreads, I know it's a famous strategy a lot of people use. The idea is that they're all very similar, right? So if you like to do calendar spreads on earnings, I know that it's been advertised in a lot of places. Great, there's nothing wrong with that. It's still the same risk, right? Even if you do calendar spread, you lose money when you have an outsized trade, right? You have an outsized trade like DVN, right? Or Amazon, right? Amazon, estimated move was 10%, but it moved 20%. So if you're doing vertical or you're doing calendar spread, that short strike, you're losing money, right? You're losing money. But, there's nothing wrong with the one or the other strategy, just whatever you feel more comfortable with. Carmen, what causes steepening of the yield curve? Usually macroeconomic conditions, right? When everything is nice and wonderful and the weather is nice and everybody's making money and low unemployment and we're in the bull market, the yield curve steepens, right? The 10-year yield pays you more than the 2-year yield and it continues to steepen. Because the idea that the future looks bright. When the future looks a little dark, then, the yield curve, going the other way. It flattens, right? And when you say steepening, to which side? To the upside or to the downside? So to the upside, it's because everything is great. If it does steepening to the downside, then because it's, this is a recession, and this is the, what is it called? Prosperity, or I forgot the term. Expansion, so that's the yield curve does this when everything is great, and the yield curve does that when things are not as good as everybody thinks. Current yield curve is current yield curve is, can't draw it too exactly, but the 2-year yield, right? We have 2, we have 5, and we have 10, right? And if this is 4, right, and this is 5, the 2-year yield is 4.5, 5 years 4.24, and 10 years. So it's like this. All right. So the question is, if the 2-year shifts this way and 10-year shifts, or not even, either down, probably not going to do down. It might down, but it might shift less here. Then it's a problem, right? If it's at the same rate, small rate, it's a problem, right? So this would be bearish. But if the 2-year yield pulls back and 10-year yield pulls back even more, then banks will rally. So Desi, Carmen, let me know if this makes sense. Yes, Scott will be at the closing bell. Yes, Scott will be at the closing bell. All the recordings are under Elite Circle recordings or Yellow Tunnel. You know, each of the service has the recording sessions. All right, 1. So, okay, going back to the poll. So, okay, 1, 2. Okay. 1, 1, 1, 1, 1, 1. No idea. 2, 2, 2, 2. All right, so half and half. I'm gonna say 2. I'm gonna say 2. So my vote goes to 2. By Friday, we dropped to 370, somewhere around 370. You know, so 375, 370. So I favor 2. You know, I favor this. And then after midterm elections and CPI data, this. Right, so that's my core scenario. Because right now, market is overbought. 390 is, you know, it's a pretty big overhead resistance. Something significant has to happen to break it. And, you know, I'm going to make an assumption that whatever Fed says is already factored into the price action. You know, it'll be one of those selling rumors type of thing. But, you know, still going higher. So that's my core scenario. Lower, higher. Thanks, someone to... All right, Carmen. Yes, I mean, Dr. Maneker changed my professional, you know, life, you know, as a trader, right? Because I was all about, you know, ego. I have to be right. I have to be, you know, when the trade goes against me, I would get upset about this. But in reality, you know, he can shift your brain in the right direction, right? And, you know, I can say it 100 times, but obviously we spend a little time. When you do one-on-one, you know, with Dr. Maneker, you know, he will change your professional career for sure. That's yes, banks rallied despite right. So I mean, this is long-term trend. This is not, you know, the long-term trends. XLF sold off, you know, more than S&P because of the steepening, because of the yield inversion, right? Banks sold off 30% and spiders 25%. And we have this rally because in every bear market there is a rally. But, you know, will it break this downtrend? Probably not. And it probably, there is more room to the downside than to the upside for the banks. Yes, we all have to, you know, trading requires you to rewire your brain. It does, because the way we raise, I mean, obviously, I don't want to generalize that we all raise differently. We have different background, but some of the themes do reoccur, you know, ego, you know, you have to be right, and, you know, using exaggerated expressions when you think. We all been conditioned like that, right? So for trading, you have to rewire your brain, and it takes time and effort. It takes time and effort. All right, guys, it's 9:20. Thank you very much. Have a great day. Keep an eye on the Fed. Keep an eye on the unemployment number. Keep an eye on midterm elections. Be ready for this 2% move up and down. It's going to continue. The only way to hedge it, you know, 50% in cash, 4 positions, 2.5% stop loss of account value at the risk. Do not lose more than 10% of your portfolio. Be long and short the market at the same time. If you trade in options, if you're managing $10,000, consider only trading strikes under $10, under $100. Thank you very much and have a great day. Desi, I think JP Morgan is going to continue going higher, right? But there's more risk to the upside, to the downside. So, you know, I would do a spread bullish. I think bullish spread is fine, you know. But if there is a negative surprise, JP Morgan is going to sell off a lot. If there is a positive surprise, JP Morgan is going to move a little. So for that reason, you know, I close my XLF long position and still have a long-term put spread, because the risk is there's more risk to the downside. even though I think market will continue going higher. But if Fed is hawkish, there's definitely a lot more risk to the downside. All right, Naimas, Carmen, Dazi. Thank you, guys. Everybody, thanks a lot. Take care.